Right. So this particular session, good people, we are looking at International Accounting Standard number 12, which is income taxes. Right. So we commenced with the topic in the previous week. We are continuing today on the same topic. Right. So this is relevant for CTA1, CTA2, and also for the guys doing CT1. Since we are introducing income tax and basically just revising the prior learning in your undergraduate studies. All right. So next week we'll then add a few more complications to the work that we've already started. But for this week is still a continuation of that introduction. So in our previous learning, in the introduction last week, we concentrated mostly on the theoretical aspect of International Accounting Standard 12. So what we want to do today, we want to look at a practice question, right, so that we can augment the work that we had started in the prior week. So that is where we are. We are still at the introductional level, right? We are doing a practice question, but it won't be a very difficult one. You'll probably see something slightly difficult in the following week. But there is nothing difficult really with income tax. Income tax is one of the most friendly topics that you can do in your syllabus here. You just need to understand it and make the most out of it. Right, let's recap on the work that we did in the previous week. Right, remember we had discussed the issue of income tax here. Right, what we call the income tax expense. Right, so in our discussion, we did highlight that the income tax expense, right, is accounted for in the P&L account under the profit before tax. So usually where you have your profit, right, before tax amount, right, whatever figure that you'll be having, then you can have your income tax expense here. Right, so normally you don't write income tax expense, just write income tax there. Right, then when you deduct that, you are then able to get your profit for the year. Right, so the work that we want to do in the P&L is to show how we arrive at this particular figure here. How do we get this figure that we call the income tax expense? So obviously after that, you then get your profit for the year. Right, if you have other comprehensive income, you add the other comprehensive income, and then you can get your total comprehensive income. Right, so the question is, how do we determine that figure? Right, we know that we have got a tax rate that is applicable for the determination of income tax, which is currently sitting at 27%. Right. However, the calculation of this figure, we said you don't take that figure and simply multiply it by 27%. Right, you will not get the correct figure. Right, the reason for that was because we said there are certain things that we recognize in the calculation of profit before tax, which don't have an implication in terms of taxation. Right, who remembers what we called those things, those differences? Right, so
Exempt differences.
those are exempt differences. So they will be
Deductible expenses.
affect taxation. So if you now take the profit before tax and multiply by 7, you'll be also multiplying those things that don't affect taxation, which are exempt differences. Right, so theoretically, we can say to calculate the income tax expense for a particular year, you can take your profit for the year, right? Take your profit for the year, and then you deduct exempt differences for that particular year. The answer that you get, you multiply by 27%, right? That will give you your income tax expense. Right, so this is one way in which you can actually calculate this figure accurately. Right, however, for the purpose of this module, and your studies in the future besides this module only, right, this particular method of calculation will not be applicable. Right, this one is correct, yes, but for the purpose of understanding what you are doing. Right, so the more,
Sorry, David.
please mute, thank you. Please mute if you have noise.
Okay,
And
no,
then,
thank you.
yeah, what you do is if you're commenting, just unmute, make your comment. We'll appreciate that immediately after, then you switch off again. Any more time that you want to comment, you switch on, and then after switch off, then that way will be very, very much comfortable in the class. All right, thank you. Right, so the appropriate way of calculating this so that you earn marks in the exam, this is another way that you can calculate, but they don't examine that. You can just use that for the purpose of understanding only. But in the exam, what they want when you calculate income tax here, right, you add what is called the current tax, right, plus the deferred tax. Right, usually you will say movement in deferred tax. Right, so it is your current tax plus the movement in deferred tax. Right, if it's a deferred tax asset, all right, let me say plus or minus here. Okay, because sometimes you subtract, sometimes you add. All of that I will explain as we go along. Right, let me give you a small example before we go to our formal question that we want to do. So when you calculate income tax, you need to add the current tax for that particular year, plus or minus the movement in deferred tax. It will give you exactly the same amount as you will get there. Right, let's go through a quick example before we attempt the question, just to refresh. Right, let's say we've got company A. Right, let's say company A has got profit before tax, right, of 1 million. This is after taking into account the following. Right, so after taking the following into account. Right, let's say number one, depreciation, right, of, let's say 50,000. Right, let's say the tax allowance, right, was 100,000 here. Right, number two, let's say prepaid expense, right, of 20,000. Right, so let's say our year here is 2025, right, ending on 31 December. Right, then we can just add company started operations, right, in 2025. So this is a new company. It only started at the beginning of the year, right, in the year 2025, and we're at the end of the year. Right, so we want to look at this. Remember, we did indicate that besides the exempt differences, right, we have another set of differences that we call the temporary differences. Now, while exempt differences are items of income and expenditure included in the P&L which don't have an impact in terms of taxation, the temporary differences do have an impact in terms of taxation, which means we should include them in the calculation of taxable income. But there is a difference of timing between accounting and SARS. So something that we recognize now, SARS may recognize in the next year, or may have already recognized in the prior year. Or something that we don't recognize now, SARS recognize now, maybe we recognized it previously, or we recognize in the next year. So which means there is a difference of timing. So that's a temporary difference. Now, what you should always remember is that temporary differences do affect the calculation of the income tax. That is why in my submissions here, I said profit for the year less the exempt difference, because these will never affect the income tax expense. So they are not included in that calculation ever. Right. However, the temporary differences are included there. And from an accounting perspective, we are going to include them in the year in which we recognize them for accounting purposes. SARS can decide to include them in the next year or could have included them in the prior year. It doesn't change anything for the purpose of accounting because we apply the accruals concept. Right, SARS may apply a different concept, but we stick to the accruals concept. So if an expense is recognized by us now, it has to also affect taxation now. To SARS, it may affect taxation next year. So that will bring a difference in terms of the tax figures between accounting and SARS. And that causes deferred taxation. Right, by nature, deferred tax is a byproduct of temporary differences. It is never an impact of exempt difference. Right, are we clear, good people? Are we on the same page? Right, are we
Yes, sir.
together? Wonderful. So we want to look at our example here and say, let's look at what SARS is going to do. Right, with regard to the information that we have provided here. Right, we know that SARS calculates what is called the current tax amount. Now, the current tax amount is the amount for the current year that is recognized by SARS as your tax expenditure, and therefore that is the amount that you should pay. We always start that with the profit before tax. Now, remember, this is being done by the accountant in order to estimate their tax burden and submit a return to SARS. So therefore, the accountant will do this on the side, outside the bookkeeping system, and determine what they owe SARS. Right, I'm telling you that because I want you to have the mental picture that the accounting principles are still applicable in as far as how we deal with tax. However, when we make the payment, we pay according to the rules by SARS. So this calculation is simple so that we can determine the amounts that SARS wants. But the income tax expense is determined by the accruals concept, of which the accruals concept is saying, if I've got an expense that I recognize now, it should therefore result in an impact in taxation in the current year, not according to the rules of SARS in the future. But it doesn't matter, we are still going to pay according to SARS, though strictly adhering to accounting principle of accruals concept. Right, so our profit before tax amount, this is the accountant now. He's not going to start from scratch and say, I want to calculate taxable income. Then I start from scratch when you already have the profit before tax. He's going to adjust that. So as usual, when we adjust that, we look for exempt differences. In this particular example, I did not offer any. Right, let me add that here, the cost of the asset that is being depreciated here. Let's say the cost of the asset is 400,000 rand. The original cost, right, was 400,000 rand. Right, the exempt differences, we have none. Then we have the temporary differences. Right, on the temporary differences, I'm going to list them. Though in practice, you don't list them. This is for exhibition purposes only. Right, we are going to say, what are the temporary differences that we have in our example? Who can say? Right, number one, depreciation versus taxable allowance.
Allowances.
In accounting,
Prepaid expense.
thank you. In accounting, we recognized depreciation of 50,000. But SARS does not recognize depreciation. They don't know that word. Right, they've got their own calculation, the equivalent of depreciation that they call the tax allowance, and the figure may differ from accounting, as you can see. So they have 100,000. So what do we do? Remember, we have the profit before tax. We want to change it to taxable income. So we want to come here and say, how would this have differed if the calculation was being done by SARS? Then we'll say SARS would not have recognized the depreciation. Right, our depreciation is 50,000. In calculating profit before tax, we had deducted that amount. SARS does not recognize depreciation. So therefore, to adhere to taxable income calculation, we are going to add that figure back to reverse its impact from the profit before tax. Right, once we have dealt with depreciation, we then say, what is the amount that SARS would have recognized? They would have recognized tax allowance at a figure of 100,000. This is the figure that we then deduct. So we are saying in this situation, we have now aligned with SARS. Right, then we go to the next one and say, this one is also a temporary difference. How did you treat it in accounting? A prepaid expense, what do you do concerning that? Do you edit it? Do you take care of it here, or you take care of it in the next period? That's a prepaid.
In the next period.
Right. So in accounting, we don't account for it now. We are going to account for it in the next period. Right. However, for tax purposes, as long as with regard to an expense, you have already made the payment in the current year, you should account for it in the current year's deductible. SARS normally works on a what? Invoice basis or cash basis, while accounting works on an accruals basis. No wonder why we have a difference in terms of what? Treatment here. SARS is saying you have already what? Made the payment. We do allow you to deduct this. So therefore, it means this will be deducted. Right, we said the figure is 20,000. So you'll be allowed a deduction. Now remember, we don't have to reverse anything here because we never included it. It's unlike this one where we say depreciation, add it back, and then deduct the allowance. We are simply saying that the prepaid expense was never there in 100,000, but SARS allows a deduction in the current year. So therefore, we are going to deduct that particular amount. Right, so when we have that now, we can then add and get our total. So let's see what we have. Right, so that's 120 minus 50 is going to give me 70,000. Right, so we have our 70,000, which happens to be negative. Right, once we have that, the figure that we get is now taxable income. So we have aligned our calculations with SARS. Right, made sure that on our profit before tax where there were differences, we have ironed them out. Then we get the amount there. Right, so if we add, or if we deduct there, we're going to get 930. Right, we get 930,000. Right, so that therefore, when we want now what we call the current tax, right, then the amount is 930,000 multiplied by 27%. Right, which means 930,000 times 0.27, we then get 251, right, 100. Now, this is the amount that we have got to pay. Even though we don't agree that it is the expense that we have incurred because of the differences in principle. Right, for accounting purposes, right, our income tax expense, right, we take the profit before tax 1 million. We then say, are there any exempt differences? There were none. So therefore, our actual figure of expenditure is 270,000. This is the expense that we would have recognized in accounting. Right, so for our double entry, what we want to see in our books in terms of the P&L is this amount. Right, however, the amount that we are going to pay over to SARS, we pay according to the dictates of SARS. So there is going to be a difference between these amounts here. Right, and the difference is what we call deferred tax. So we then say 270,000 is the expenditure recognized by us, but we are paying only 151,100 according to SARS, right? Which means 270,000 minus 251,100. Then we have a deferred tax. Right, this is deferred tax because we have underpaid our tax figure. According to accounting, this is the expense that we recognize, but we have paid that. So therefore, this amount represents a liability. So this is a deferred tax liability. It's a liability because we underpaid our tax for the year based on accounting principle. Right, are we clear about this, good people?
Thank you, Mr. Perry.
Right, Mr. Love. Here is the tax guy.
Sorry.
Stress. Right, now, if you understand that, I'm going to show you what is called the statement of financial position approach. This is what we apply in our questions. Right, statement of financial position approach. Right, so from now onwards, what we were doing last week, it was just to build up to this. And also just because deferred tax is a little bit tricky, people don't even understand what they are doing there. Or they can calculate, but they just don't understand what's happening. It was just meant to give you proper understanding of what deferred tax is. Right, so what happens is this. What happens in the P&L will affect us in the statement of financial position. Right, let me just also show you. Right, remember we said income tax, right, is equal to current tax plus deferred tax, or plus or minus deferred tax. Right, so if we go to the current tax figure, we have a figure of 251, 100. Then if we go to deferred tax, we have 18,900. So most of your calculations that you do, right, or how you're expected to calculate and deal with taxation, right, your questions will require you to calculate current tax first, and then require you to calculate income tax. And then thereafter, they would want the income tax. So now what you do, you simply add these two, you get the income tax expenditure, right, which is your amount of 270,000 there. But sometimes it can be a minus. I will show you exactly when it is a minus, right? So it simply means if you don't have that, but you already have this and you already have that, income tax, you just add the two, then you get your figure. So your questions and how the exam is set up, right, they won't normally require you to do the calculation that I did. They will ask for this by saying calculate deferred tax, calculate current tax, and then do what is called the tax rate reconciliation after. Now, to do this, you will be applying what is called the statement of financial position approach. Now, when we use the statement of financial position approach, what we then do, right, let's say we're in the year 2025, we calculate the deferred tax balance. Right, so we go to the year 2025, right, we calculate our deferred tax. Right, to calculate the deferred tax, we'll then say carrying amount, right, temporary difference, carrying amount and then tax base. Then the difference will give you temporary differences. Then you calculate now deferred tax. So what is happening? Whenever something happens in the statement of financial position, whenever there is a movement in the statement of financial position, right, it will have an impact in the P&L. So remember, in the statement of financial position, you have your balances of assets, balances of liabilities, right, balances of equity. Right, so when there is a movement in an asset and a movement in a liability in the statement of financial position, it will be captured also in the P&L. Right, so here, what we can then do is you go to the statement of financial position. You identify your assets and your liabilities. Right, then you need to capture the carrying amount as well as the tax base of each asset or liability. So in this example, if we say the assets that we had, we didn't name it, let's say it was machine. We then say we have a machine here, right? This machine was acquired for 400. Then we depreciated it by what? 50,000. So therefore, the carrying amount is now 350,000. Right, then we go to the same asset, we say, what is the tax allowance? 100,000. From 400,000, then we have 300. So we have calculated effectively the carrying amount and the tax base. Right, the tax base is the equivalent of carrying amount in accounting, but based on tax principles. So it is the cost of an asset less the tax allowance. And then we have a difference of 50,000. Right, if you look at this, this is what we were capturing here. This is the movement that we got. Right, in the P&L, we had 50,000 in depreciation, and then we have a tax allowance of 100,000. Right, the difference between the two gives you 50,000. So we are saying this difference that we have here can be calculated via the statement of financial position by simply looking at the asset and saying, what is the carrying amount of the asset? What is the tax base of the asset? We get the temporary difference. Right, from there, we can actually go ahead and say, right, if our tax rate is 27%, what will be the impact of that 50,000 on deferred tax? So we say 50,000 times 0.27, we are going to get an amount of 13,500. Right, so you'll be done with your deferred tax calculation in as far as the machinery is concerned. Right, so we know that what has happened here, right? There is a difference, a temporary difference here of what? 50,000 that we're able to capture in our current tax calculation by listing those two. So this gives you a difference of what? 50,000. Right. However, remember the depreciation and the tax allowance are being deducted from the same asset. So if we look at the carrying amount of the asset and we look at the tax base of the asset, it should give us the same difference, which is what we are having here, 50,000. So the same impact that we calculated over there, we can still calculate it here. Are we on the same page, good people? Are we understanding it? Right. The question is this going to lead to a deferred tax asset or a deferred tax liability? Right. We have the rules in accounting for deferred tax. So these rules, let me write them here. Right. It's going to be a liability. Thank you. So the deferred tax, right, so we call these the deferred tax rules. Right, when you are dealing with an asset, if the carrying amount of the asset exceeds the liability, then it gives a deferred tax liability. Right, remember a deferred tax liability, good people, we are saying your tax according to accounting is more than the current tax that you paid. So you underpaid your tax you are owing. So if the carrying amount of your asset is less than, right here, I wanted to say tax base, right? If the carrying amount is less than the tax base, what does it tell you? Or if your carrying amount is bigger than the tax base, it means you deducted a lower amount of depreciation than the tax allowance. So what it means, because you deducted a less amount, your profit for the year, your profit for the year would be bigger than the tax base. If your profit for the year is bigger, you then have a bigger tax base, and therefore, a bigger tax amount than what you're going to pay in taxation. Right, I hope someone got that. right? So this gives a deferred tax asset. It's the opposite. Then liabilities are opposite of assets, which means if the carrying amount is smaller than the tax base, then you are dealing with an asset, right? If the carrying amount is bigger than the tax base, then you are dealing with a liability. So these are called the deferred tax rules when you apply the statement of financial position approach. Right, if you forget the rules, it's very easy to deal with that, not a problem at all. What you do, you go to your question, you go to your calculation here, right? Assets, you put them as positive amount, right? Liabilities, you put them as negative amounts. So negative amounts, you put them in brackets. So when they are not in brackets like this, these are positive amount. So that when you get a positive amount here, then here it will always be a negative amount representing a deferred tax liability. Right? If it's the other way around, mathematically, you find yourself with a negative figure here. Then what you get here should be a deferred tax asset without brackets. And that way you will always be right, even if you forget the rules. Right, let's go to the other item that we are having, which is the prepaid expenditure. Now, the prepaid expense, we have to think about it. It gives you a balance in terms of accounting. So we'll have a prepaid expense here. Right, remember we said, Tina, we are not going to deduct that expense in the current year. Right, however, we are going to create an asset under the current asset of prepayment, which is 20,000. SARS does not recognize a balance on a prepaid expense. This is because SARS did allow you to deduct the amount in the current year, so they don't have a balance in their hands. Right. Are we clear, good people?
Yes.
Now we have a balance because we did not allow it, and then we actually, using the accruals concept, created an asset indicating that whoever we paid is now owing us because we paid them before they actually provided the service. Right, so this here gives you 5400, which is also a deferred tax liability. Right, then from there, we'll be done with our calculation of deferred tax. Now, it is important to remember, right, you have to look at assets and liabilities. And then those assets and liabilities which have got a different carrying amount and the tax base, they will give you a temporary difference. Right, 70,000 times 0.27, that will give you 18,900, which is a liability. How much is that figure and what is it equivalent to? Right, this was our calculated what? Deferred taxation. And this is equivalent to the same amount. So this method here of calculating that figure is called the statement of financial position approach. Any question? Right. Once you have that, usually your questions will then say calculate current tax. Right, so they will require you to make a calculation of this year. Right, so if you have the statement of financial position and you want the current tax, this is how you calculate it. Right, so there will be a slight difference in terms of how we calculate the current tax. We will still start with the profit before tax.
Profit before tax.
Right, so profit before tax amount. Right, which amount is 1,000 based on the previous. We'll bring in the exempt differences. If they are there, no exempt differences here. Right, then we bring in, right, now on the temporary differences here. So usually you would just calculate and have your balance remaining. Right, so you will have your 100,000 there. Sorry, 1 million. Right, then you say movement in temporary differences. Right, as for the movement in temporary differences, what you do, you calculate it below here. Right, you take your temporary differences for the year, which is 70,000. So it will be your current year minus the prior year. This is a new company. We did not have anything in the prior year. So you still have 70,000. If you had 2024, you are going to put the figure for 2024. Right, so this one, you just say temporary differences total for the current year minus that for the prior year, then you have a total. Then you multiply it by the tax rate, it gives you 19.8, right, which is still what? Negative. So what we are looking for is this particular figure here. That's your movement in temporary differences. So this is the figure here that you bring there. Right, if it is a positive amount here, when you bring it down, you are going to deduct it there. Right, this here, if it's positive, it's what is called a taxable temporary difference. In the future, that amount will be added to the taxable income of the next year. It increases future periods, but it reduces in the current year. Go to the definition of taxable temporary difference that I gave you. In the next year, it increases the taxable income. In the current year, it what decreases. If it's a positive amount, it increases in the next year. So therefore, in the current year, it decreases. So you won't have to list each asset one by one here. You just take that movement and it will give you 930. That's your taxable income. Right, so in other words, you will not be required to show individual movements in temporary differences, but that value here will be captured in this calculation there. It will be captured via this, and this figure is what you bring there. And you will see that at the end of the day, you are calculating exactly the same as there. And eventually you get 251 here. Right, 150, I think it was 251, 100, isn't it? Yeah, 100. Right, so this will be your current amount or current tax. Right, this is the amount that we are going to pay. Right, so what have we now? We now have the current tax amount. We now have the deferred tax amount. So now we can calculate income tax by saying what is the current tax amount? Right, 251, 100. Right, then from there now you go and check the deferred tax that you have, 18,100. So you bring in the deferred tax, which is 18,900. Right, again you do the same thing. Right, if it is a negative amount there, when you bring down, it's a positive amount, which means you add. Remember, I said sometimes you add, sometimes you subtract. So it is easy when you use this approach. You just check the symbol here. Is it a deferred tax positive amount, which means asset or liability? Here it's a liability. When you take it to the section below, it goes in as a positive. You add. Right, please go ahead. Nompilo, I think.
Okay, good evening, everyone. Okay, Davis, my question was on the movement in deferred tax. So let's say in the year 2026, I created this one, it was the year 2025. In the year 2026, we got an amount. When we calculate the movement in temporary difference, is it going to be that amount of 2026 less the negative 70,000 or less the positive 70,000 of the previous year?
Remember, whenever we calculate deferred tax and the company was in existence at the end of the previous year, right? When you want to calculate deferred tax movement in temporary difference, movement in deferred tax, you calculate the current year and the prior year. Then you calculate the movement between the two. So here we said movement in temporary difference, which is what? Your movement current year minus the prior year. Same with the deferred tax. You say current year minus the prior year. So whatever you get mathematical, that's what you use. So if it's a negative, you say minus 18,900 minus whatever you have in the prior year. The answer will come out to this.
Okay, thank you.
Sharp, sharp. Right, so this is how we are supposed to calculate our deferred tax. And you can see that at the end of the day, this calculation here, which we did this way, will come out exactly the same if you calculate this way. We end up with what? 270. And this here is what we call the tax rate reconciliation. So you see most questions will ask for the tax rate, not tax rate reconciliation, right? Disclosure of income tax expense. Right, disclosure of income tax expense. Right, and this amount that you end up with 270, this is what you are going to show here. Right, this is what is going to go there. Right, there won't be this amount multiplied by 27, you get a wrong figure. So this amount is calculated the way that we have demonstrated here. And this is the statement of financial position approach. Any questions, good people? Are we on the same page? Right, are we clear? Anyone who doesn't understand a certain portion here wants me to explain again before we move to a question?
Yeah, before you move, I just want to find out from you. Are you
Yes.
saying during the test or the exam, the question will be basically on the statement of financial position approach, not on the PL side?
Yes, in terms of how you deal with deferred tax, current tax, the questions are very specific. They will tell you to use the statement of financial position approach.
Okay.
Right. If you go maybe to the study guide, initially they will show you this method just for learning purposes, this one. But they will tell you that in our exams, we are going to exclusively use the statement of financial position approach. So what we need to do is use the statement of position approach in our calculations. But if you want maybe just to have a proper understanding to be able to explain to someone what deferred tax is, right, you need to have an understanding of what we did prior. Right, let's go to our question. Yes, ma'am.
David, please, can you kindly just go back to the disclosure note? I just want to jot down something quickly, please.
Okay. Right, the question that we have is going to have a more comprehensive disclosure note. So this one is just an exhibition. Eh?
Okay, thank you.
Sharp, sharp. Right, there is a question that I want us to do. Let's see, I think I did download it. I want to share it with you on the group there. Did I download it or not? Nah, I think I did not do that. I did not do that. All right, let's follow each other on the board. I will share the question after the class. I didn't download it. All right, so this is my question here. Right, this question is from FAC 4861, tutorial letter 102. So the guys doing undergrad, you don't have this one. I will share with you after. So don't worry if you are doing CT1, this particular question is very much relevant. There is nothing new or difficult here. Actually, if you are doing 3764, which is the CT1 module, what UNISA has done, because you students were struggling with CTA after passing your undergrad, the module 3701, which carried this topic, it was slightly easier, very, very easy compared to what you do at CTA. So what they then did was to create another module, 3764, which is an upgrade on 3701, but just slightly below CTA. So if you do the CTA stuff, you will be very, very good in your module. If you do the 3701 module, you will find trouble in the exam. You must work with the stuff that is almost similar to CTA. to then have no problem at all with your own module. Right, so this is the question that we have, tutorial letter 102. If you already have your 30 material for CTA, you do have the material. So we are looking at question number 5.1. So it means you have to go to start the, on your tutorial letter 102, you have to go to topic number 5, income tax. Now, in terms of the requirements, this is what they want. Number 1, or number A, present the above information in the statement of profit and loss and other comprehensive income, right? Commencing from the profit before tax line in the statement of finance and in the statement of financial position for the year ended 29 February 2012. Please note, only present tax-related account balances in the statement of financial position for April. I don't know what April is doing there. Someone was changing the question and made a mistake with the date. Right, for the year ended 20 February 2022. And then they want disclose the notes with the financial statements for the year ended 28 February as required by International Accounting Standard number 12, income taxes. All right, so they then say the movement in temporary differences is calculated in the current tax calculation must be calculated using the statement of financial position. Now, this is a default with all your questions. They will want the statement of financial position approach. Right, first we have to do presentation, right, of the P&L and also the statement of financial position. So what's the name of the company? Oh, that's April Limited. I thought that was a date. That's April Limited. Right, so we are saying April Limited, right, a statement of financial position, a statement of P&L, right, and other comprehensive income. Right, and other comprehensive income for the year ended. Right, 28 February of the year 2012. Right, so what they want, they said you can start with the profit before tax figure. Right, so we should start with the profit before tax amount. Right, so we should start with the profit before tax amount. Right, profit before tax, and then after that, you will then have your income tax amount. All right, then you have your profit before tax. All right, and then you can have your other comprehensive income if you have that. All right, then you can have your total comprehensive income. Right, so this is the structure, right, of our presentation in the P&L. Right, when someone says present, they are saying show us the statement of P&L, show us the statement of financial position. When they are saying disclose, notes. Right, then we also have April Limited. Right, statement of financial position. Right, as at 28 February of the year 2012. Right, so here they don't want you to show everything, just the areas impacted by taxation. Right, so for this question, we were impacted under the equity and liabilities section. Right, sometimes you may have the asset section if you have deferred tax asset, but here we're going to have a deferred tax liability. So under the non-current liabilities, right, this is where we present deferred tax if it's a liability. So we're going to have deferred tax liability. Right, then under the current assets, right, we are going to say SAS. Right, we are dealing with current sales here. Right, so our calculations, we have to look for these figures that go there. We have to look for that figure that goes in income tax. So we'll come back when we have those figures. Right, then after that, we are going to have April 2012, and then we say notes for the year ended. Right, our year end, 28 February of the year 2012. We want to present what is called the income tax expense note. Right, so we are going to come back to this. So now we have our structure. Then we can do the workings below. Right, let's read the rest of the question. Right, it says here, the following information was extracted from the books and records of April for the year ended 29 February of the year 2012. The deferred tax liability as of 28 February 2011 was made up of the following. Right, so we are already given the deferred tax of the prior year. Right, it was made up of property, plant, and equipment. There was a temporary difference there, and contract liability revenue received in advance. Right, so then it means the company has been in operation, and we have the figures that made up the deferred tax calculation of the prior year. So we need to calculate for the current year and then compare with the prior year. Right, profit before tax for the year ended 28 February 2012 amounted to 735 and included inter alia the following: foreign income, dividend, profit on sale of assets, fines, legal fees, depreciation, etc. Right, so these ones, foreign income, dividend income, fines, legal fees, and maybe 20% of that, these represent exempt differences. Right, especially the portion that is not deductible in terms of the legal fees. The one that is tax deductible, it is not going to represent a difference. Right, legal fees, donations, such things, you look for where it says not tax deductible. That's what represents a difference. But the deductible portion does not bring a difference. Right, so this is what we have, and then they continue and say, profit on the sale of land relates to the land that was sold during 2012 financial year. The land was measured using the cost model. The carrying amount of the remaining property, plant, and equipment was, as of 29 February 2012, was 2550, and the tax base was 1360. Right, so we have been given the carrying amount and tax base of the remaining property, plant, and equipment at the end of the year. The property, plant, and equipment does not include any land except as referred to in paragraph 3 above, right, or any assets which are being recovered through sale. The current liability revenue received in advance in the trial balance reflects a credit balance of 62,000 at the end of the year. The creditor account of the South African Revenue Services relating to income tax in the accounting records of April Limited at 29 February 2012 was made up of the following. Right, remember, when it comes to taxation at the end of the year, right? You put yourself in the shoes of the SARS authorities, you calculate your current tax, which is the amount that you are going to pay to SARS. But usually the payment is not immediate. You have a particular season where you are expected now to make the payment. Right, so before making that payment, the amount that you are actually owing SARS, you have to provide for it in the books and create a liability, right, which is this particular thing that I'm talking about. Right, so here, remember, we're saying how much are we owing SARS, which is going to be paid within 12 months from the end of the year. I said asset there, it's liability. Right, so that is the current tax. So what they are telling us here is how that account is looking. Now you must be very clear. This amount is a provision. A provision is a liability of a certain timing and amount. Now this is uncertain because you have calculated it on behalf of SARS. You are using it to estimate the expenditure that you owe SARS. However, SARS can come through and say, no, we don't agree with your figures, and you end up changing those figures to align. Say, for example, you have an accountant who is not very good up on this, and they make a mistake somewhere. When you then make a provision at the end of the year, based on your own figures, you make submissions to SARS. 3 months down the line, SARS comes and says the figure is incorrect. This is what the figure should be. And if you agree with SARS, it means that you either over-provided or under-provided. So this is what is happening here. Right, so we are given the account with the South African Revenue Services. So this is the T account or the SARS account. It shows here a balance at the beginning of the year. So this is balance on 1 March 2012, provision in respect of the 2011 assessment 31. So this is what you would have provided in your books in accounting. Simply saying this is how much we think we owe SARS. Then this is what happens. The payment actually made in final settlement of the 2011 assessment, no interest or penalty were charged. So this is the amount that you had created and provisioned for. But eventually to settle the amount you paid this, right? There is a difference here on the amount that you eventually paid and the amount that you provided, and the figure would be 1.5. Right, what does it tell you? You over-provided in your books. SARS then came to you and gave you the correct figures and you agreed with them. So you settled with them at 29.5. So this amount represents a over-provision. Right, in 2011. Now we have already closed the books in 2011. We are now in 2012. We are now in 2012. So what does it mean? You cannot go back and correct the provision in the prior year. It has to be corrected in the current year. Now, current tax represents an expense. If you over-provided an expenditure in the prior year, what must you do now? You overcharged yourself in the prior year. So what SARS does allow you is to then come to the current year, you will be allowed to reduce your expenditure for the current year by the 1.5. Are we clear about that, good people? Right, hello?
Yes.
Okay. Right, so that figure of 1.5, you need to deduct it from your income tax expense for the current year. Right, then we have what is called a provisional payment made in respect of 2012. Now, provisional tax payments is a system provided by SARS to allow taxpayers to pay periodically and in advance before the payment is due by SARS. So in other words, we are saying, right, SARS does allow me, let's say I'm a provisional taxpayer and my year is ending on 31 December. But the payment maybe is expected on 31 March of the following year. SARS can then allow me, say, give me an allowance to pay on 30 June. Right, 30 June, make my first payment. On 31 December, make my second payment. So what SARS will be saying is, instead of me waiting to make a once-off payment here, which may be very difficult for me in terms of cash flows, because it means I must keep money and make sure that I have the money on hand on 31 March. That's a problem because challenges do come and I may use the money. So what SARS does is to say, okay, how much do you think you are going to be expected to pay here? I calculate the total amount and then they say pay half here. Right, then I come here, they say, do you think you're still going to pay the same amount there? I say, I think I made a mistake with my estimation. Maybe the figure has increased slightly. They will say, how much? So if I paid 5,000 here, and then I say, I think the total amount is going to be 20,000. They say minus 5 that you have already paid. So then I'll pay 15,000. So then it means before the 31st of March, I have already paid 20,000. If it then comes out that I should pay 25,000, then it's easier on my cash flows because I've already paid the bulk of the money. I'm paying 5,000. So chances of defaulting are very slim. And it's good for SARS because they don't have to wait for their corporate tax money only in March. They can collect it periodically during the year. So if the government has got challenges, they do have funds in the what? In their coffers. So that's provisional tax payment. Are we clear, good people? Right, so this company has already made provisional tax payment here for the current year. So I'm extending the T account. So it simply means these are prepayments based on estimates that they've already included in the books before the end of the year. Right, then they say the foreign tax payable account in the trial balance had a credit balance of 46,200 on 28 February. This amount relates to the foreign income received of 132 in the financial year ended. No foreign tax was paid over during the financial year. So remember, we have got this amount. So if you say 132,000, this amount is the foreign income. This is an exempt difference. It means the South African company earned income in a foreign country. And remember what it means. They have to pay tax there, but they are not going to pay it in South Africa. So the tax there in the foreign country is at what? 0.35, which gives you that 46,200 there. Right, so we'll have to account for that. It means this is an additional expense, but it was charged outside South Africa. Right, I'll show you where it goes in. It has to go into our income tax expense for the year. Then they say, right, no objection was made by April in respect of the 2011 assessment. The Minister of Finance announced on 31 March 2011, beginning of the year, that the tax rate decreased from 29 to 28 for the financial year that started on 1 March. The inclusion rate for capital gains is 80%. Right, there was a change in rate. Right, remember, it is the Minister of Industry who announces the tax rate, and the tax rate does change. Just recently, it was 28%. Now it's at 27%. So it can change from one year to the other. And in this example, there has been a change in the tax rate. It will have implications also on our calculations. We will have to note that as we go along. Right, if you get a question like this, good people, in the exam, which I think would be very rare, it's almost impossible. Right, especially if you are doing CTA, there will be something complicated. Here, you must get everything. Remember what we have discussed to say test number 1. You have more time than in any other test that you will do. You need to maximize on test number 1. No mistake there. Right, because when you accumulate your marks, it's very good to have high marks in some tests so that even in the exam, you already have, you go there with a very good year mark. I think your year mark in CTA is 30%. So if you have, let's say, a 25% already, in the exam, you're looking for 75. So you need to make sure you get high marks here so that the pattern is less in the exam. Right, so where we are going to start with our question, we have to start by calculating deferred taxation. So this is where we always start when we have the statement of financial position. So calculation number one, we want to calculate movement in temporary differences and deferred tax. Right, so we then start with the year 2011. Right, so when we do the calculation, we open 4 columns here. Right, we have our 4 columns. Right, so we have the carrying amount. Right, we have the tax base. We go for the temporary differences. We go for the deferred tax assets or liability at. Right, remember there was a change in rate in this one. So our current rate is 28%. The Minister of Finance announced in March 2011 the tax rate decreased from 29 to 28 for the financial year after 1 March. So previously it was 29. So therefore in the prior year we have 29%. Right, then you need to calculate deferred tax for the current year. Right, so we calculate for the 2012 year, and remember this time we have 28%. Right, so this is the structure that we have. Right, the deferred tax for the prior year was already calculated. So it was made up of 2 things. So this is what they said: the deferred tax liability as of 28 February 2011 was made up of the follows: property, plant, and contract liability. Right, and contract liability. Right, contract liability in this instance, simple representing what? Prepaid income. This is what they said. This is revenue received in advance. So this one, it is a deferred tax of 271150. It's already calculated. Then the other one had deferred tax of 1340 or 340, which is a positive amount. Right, then we add and get our total, which is 257810. Right, which is our total. Now remember, in this calculation, we need to calculate also the movement in temporary differences. So we need to figure out what the figures here are. Right, remember, to arrive at the figure of 271 here, 150, we would have said whatever was here multiplied by 29%. So if we are calculating in the reverse, we simply take that divided by 29%. Then we get the figure of temporary differences. So that will give us a figure of 935,000. So this is what should have been sitting here. 935,000. Right, these 2 things, I think I need to move this down. Right. And then the one for 13, 340 divided also by 29%. Right, that will give me 46,300. Right, you see this one is negative, this one will be positive, this one is positive, this one will be negative. It's always like that. 395,000 minus 46,000. Then I'm sitting on 889,000, right? Which is a positive amount times 0.29. It gives me exactly that figure, right? So because I was already given these figures, I don't have to do too much here, right? Remember, this is a deferred tax liability. I just work from the figures that I have because I have already been given the deferred tax liabilities and the individual components of what makes up that deferred tax. Any questions, good people, on that calculation? Are we on the same page? Right, are we clear? Right, we are very quiet. Right, hopefully
Yes, we can.
everyone is on the same page.
Could you go over it again, please?
All right, so in this particular example, excuse me. Right, in this particular example, we were already given these amounts here. Right, but we need this figure, so we've got to work backwards until we are able to get that amount. So these figures, you already told the deferred tax liability on 20th February was made up of the following. So this is the total deferred tax made up of these assets and that liability. So to work backwards now, remember, you have to get the correct tax rate to use there. So this is the rate that was being used in the prior year. To get deferred tax, whatever the temporary difference that you have, you multiply it by the rate and you get the figure. So if I now have 271,150, I know I got that figure by saying whatever was in temporary difference multiplied by 29. So if I now want to get that temporary difference having deferred tax, you divide by 0.29. Then it will give you this amount. Right, take that amount again, divide by 29, it will give you that amount. Then you just add, you now get your deferred tax table from the prior year. Right, once we have that, then we go to the current year. We need to find out which assets and liabilities were we having at the end of the year. Right, in this question, they just gave you this. They said the carrying amount remaining property, plant, and equipment at 29 February 2012 was 2,550,000. So the carrying amount is already given, 2,550,000. We don't have to calculate that. As for property, plant, and equipment. In another complex question, you may need to calculate that. Then they also gave us the tax base. The tax base was 1,360,000. Right, so therefore, 2,550,000 minus 1,360,000, you are going to have 1,190,000 multiplied by 0.28, the new rate, you are going to get 333,200. Our assets is bigger than the tax base. Therefore, this is going to be a deferred tax liability. Or you can just look at this mathematically. You've got a big amount here and a small amount here. It's going to be a positive amount. If it's positive here, it is going to be what? Negative. A negative represented by brackets, that's a deferred tax liability. Right? Are we clear on that one, good people? Right, then they say the contract liability, revenue in advance. Now that's a liability. Right, the contract liability, right, in the trial balance, the contract liability in the trial balance reflected a balance of 62,000. Right, on 29 February of the year 2012. Right, so we've been given the figure of 62,000 there. So therefore, we say 62,000. This is a liability. Liability, we show them by brackets. Right, what is the value of the tax base, good people? Right, SARS does not recognize this amount, a prepayment, if it is below 100,000. SARS would have already accounted for this prepayment in their books in the current year. So it was deductible, there is no balance. Right, in principle, just say SARS does not recognize prepayments, SARS does not recognize accruals, SARS does not recognize provisions. Those will always have a zero balance. So mathematically, we have a negative 62,000 there. 62 by 0.28, we are going to have 17,360. Right, we are done. These are the only assets and liabilities in this example. Then we can calculate our total. So 1190,000 minus 62,000, we are going to have 1128,000 positive amount times 0.28, we are going to have 315, right, 840, and that's going to be in brackets. As long as it is positive there, it is negative there. Once we have that, next step, movement in temporary differences. Right, movement in temporary differences. Right, for you to calculate the movement, you must have the current year temporary differences 1128. Right, less the prior year, which is 889. Right, so 1128 minus 889,000, then we're going to sit on 239. That's a positive amount. Therefore, the movement in deferred tax times the current rate, 28%, you are going to have 66,920, and that's a negative amount. Right, so you are done with your first calculation, which is for you to determine the deferred tax amount. Now, this amount of deferred tax that you have here, this is your overall amount of deferred tax at the end of the year, 315,840. This goes here in the statement of financial position under the non-current liabilities. So that was your deferred tax balance at the end of the current year. Right? Any questions, good people, up to where we are? Right, are we clear?
Yes.
Right, then we go to calculation number 2, current tax. Right, to calculate the current tax, we always start with the usual profit, right, before tax amount. We go to the question, the current tax or the profit before tax is given. Right, profit before tax for the year amounted to 3,735 and included inter alia the following. So 735, that's the amount. Right, so in our disclosure, we have a slot for the profit for the year in the P&L, and this is where it goes. Right, once we have that, we then do the usual, we say exempt differences. Right, or we say non-taxable, right, or deductible items. Right, the first description, you normally deal with that if you are doing that 701. That's the term. Maybe the freshest term is non-taxable or deductible items. This one being an old term, which is usually only found in 3701 module. So you just say non-taxable deductible items. But if you say exempt differences, they will mark. Don't worry about that. Just trying to align with what you will see in your study guide. Right, so we then have our exempt difference. Foreign income is an exempt difference 132. You must include here the gross amount. The gross amount is the total amount before deduction of any foreign tax paid. Remember, you're paying foreign tax of 35. So if the question were to say 32,000 after deducting foreign income of 32,000, right, you would have had to say 132,000 plus the amount deducted. But here, this is the gross amount before any deduction. The wording is always important. Are we clear on that? Right, hopefully we understand that very well. Right, dividend received, the amount is 175. That's an exempt difference. Now let us remember, these items are income, and income, we have to reverse it from our profit figure. So income, you deduct, expenses, you add. Right, then we had profits on the sale of the land. Right, so this will automatically give you a capital gain. This will give you a capital gain. What is a capital gain, good people? Right, what is a capital gain? Right, a capital gain is when the proceeds, right, exceed the cost of an asset. So that's capital gain. So if I buy an asset for 1 million and I sell it for 1.2 million, the difference here, 200,000, that represents a capital gain. Right, so normally with an asset that is depreciable, the profit is not the capital gain, because you would have said proceeds less the carrying amount. Right, assuming that we sell for 1.2 maybe, but the carrying amount is now 800, we will have 400,000. Right, however, we should note that the carrying amount is different from cost. So if the asset was bought for 1 million, for the purpose of determining capital gain, limit your deduction to the cost of the asset. For the purpose of calculating profit, limit your deduction is up to carrying amount. But when you have an asset that is not depreciable like land, it means costs minus accumulated depreciation. Cost will be 1 million here. Depreciation is 0, which means we have 1 million here, which means 200,000 is both profit and capital gain, because this amount is equivalent to the original cost, because we don't apply tax allowances on the land. Are we clear, good people? Are we understanding it? Right, are we there? You are very quiet.
Yes, we're here.
Yes,
What?
sir.
So what it means in this case, sorry, come again. All right, let's see. Sharp, sharp. Right, so on this one here, even though they gave you profit, okay, they gave you profit on the sale of land, right? of 210. Because it's land, this is equivalent to the capital gain. So therefore, we are saying, remember here, only 20% is an exempt difference. So therefore, we're going to say 210,000 times 0.2, which gives us 42,000. This 42,000, this is income. So we are going to deduct and reverse 20% of that. Right, let's go to the next item that we have. Next, we've got fines and donations, and they were very clear, not tax deductible, 700. So this we reverse by adding back. So these are fines and donations. We are going to add back, these are expenses. Right, then we have got legal fees, but we only reverse the portion that says non-deductible or not deductible. The portion that is tax deductible, we don't reverse. So therefore, we'll say legal fees here. We reverse the 900. Right, is there any other? Right, we don't worry about depreciation on vehicles. Depreciation is an expense, yes, but it's a temporary difference. So for now, we're dealing with what? Exempt differences. Right, so we are done here. We then calculate our total. So we say 132,000 negative plus 175,000 negative plus 42,000 negative plus 700 plus 900. Then we get 347 here. Right, 400 rand, which is negative. Right, from the or plus 735,000. Then we're going to sit on 387. Right, so we're sitting on 387,600 here, right, which is your taxable income, right, before temporary differences. Right, once we have that figure, then we bring the movement in temporary differences. So we don't have to show temporary differences one by one. So we don't even worry about this because this is a temporary difference and its impact on taxable income will be captured in the movement in temporary difference, which is that figure here. Right, remember, if it is positive, when I bring it down here to 39,000, I'm going to deduct that. It's a taxable temporary difference in the next year. In the current year, it reduces the taxable income. Right, then we're going to sit on 148,600. This amount is taxable income for the year. Right, current tax, 148,600 multiplied by the current tax rate of 28%. Right, so we are going to sit on 41, right, 608. Right, then to conclude this calculation, if you have made any provisional tax payment, you say less provisional, right, tax payment. Right, the provisional tax payment, remember the T account, the creditor account for SARS relating to income tax in the accounting records for April. Right, then we are saying provisional tax payment in respect of 2012, 38,000. So what it means, we have already made payments of 38,000 here. Therefore, what is to end payable to SARS is the difference. Right, so 41,608 minus 38,000, we need to pay SARS that amount of 306 or of 3608. So this is the amount that is payable over to SARS, right? We are owing that amount. We don't owe the full current tax because we've already paid a portion. So what we owe, which goes to current tax, is that amount. Any questions, good people, up to where we are? Right, hopefully we are on the same page.
Sorry, David.
Yes, ma'am.
So with regard to the provisional tax, I get what you're saying, we're gonna less the provisional tax payment. Remember, SARS still owes us 1.5. What are we going to do with that 1.5?
SARS does not owe us anything. This is what happened. Remember, we made a provision in our books before SARS gave us our bill. Ne? So, Tina, at the end of the year, because in accounting we apply the accruals concept, we said at the end of the year, we know that we are owing SARS, right? But SARS hasn't given us our bill because you submit your returns, SARS checks them and authenticates them or disapproves them. So, at the end of the year, before SARS does the checking of the books and give us what is called our assessment, we had already made a provision in our books of 31. But we then waited for SARS to give us our assessment. When they gave our assessment, they said you owe 29,500, and we did not dispute that. See, this is what they are talking about. When they say here, no objection was made by April in respect of the 2011 assessment. So we agreed with SARS. It means that we saw where the mistake was, and then we paid them this.
Okay.
So we don't owe them anything. But in our books now, we would have already deducted this expense as an income tax expense in 2011. Remember, income tax expense is current tax plus what? Deferred tax.
The taxes.
Right. So what we are saying is we can't open the previous year and reverse the 1.5. But what we are then allowed to do by accounting principle, if we make an over or under provision, we correct it in the current year. Since this was an over provision, we over deducted tax in the prior year. Our tax in our books was overstated. So what we'll do, that amount of overstatement, we'll use it to reduce the tax expense in our books in the current year. Yes, and this is how it's going to play out when we show that deduction.
Okay, thank you.
Sharp. So I want to make some space here so that we can conclude our question by doing the disclosure of the income tax note. All right, let's see how much space I need. Right, somewhere here. Right. I still very close. Right. Yeah, I have enough space now. All right, so now we go to the income tax note. All right, so remember, when you do an income tax note, you must start on a fresh page. Then you have the name of the company and notes for the year ended 28 April, and then the income tax note. So what you do, you say major components as a subheading. Right, the major components that you have are basically three. You have, number one, the current tax. Right, current tax, you will then have two entries to make here. Right, number one, you will say current year. What is the current year's tax? And then number two, you will say, right, over provision in prior year. Right, so the current tax for the year is an amount of 41,608, which is that figure. Take the figure before any provisional payments. Right, then we say 41,608. Right, this is for the year 2012. These are the rand values. Right, that should go there, 41,608. Then you say in the previous year, you overcharged yourself taxation. So therefore, you are now allowed to reduce that tax amount in the current year. If it's an over provision, you deduct from current tax. Are we clear, good people? Right, are we understanding that?
Yes.
Right, so you have to deduct from the current tax to correct the error in the prior year. So where current tax is concerned, that is what you do. Then you bring in your deferred taxation. Right, deferred tax. For this type of calculation, you will have current year. Or if you want to say, just write movement in temporary differences. Right, you can say current year or movement. I think just say movement in temporary differences. Then you have change in rates. Right, then you add the two. So when I'm saying that in the next week we'll do something complicated, you will have more interest there. Right, there are other things that can go in the deferred tax calculation, but for this question, it's limited to only those two. Right, what you do, if you go to your calculation here, then you go to this particular figure here. That's your movement in temporary difference. That's its impact on deferred tax. Remember, this is temporary difference and this is deferred tax. So that's your movement in temporary difference, 66,920. So if you come here and say 66,920, it becomes a positive figure here. Right, if it's negative down there, at the top it has got to be positive. When you think about it, we are saying on your deferred taxation, you had a figure of 257 in the prior year. Now you have a deferred tax liability of 315. Now, when a liability increases, it is because of an expense. There has been an increase in the expense. Remember, we are owing for what? For tax 257, and now we are owing for tax what? 315. We have been charged more tax. Are we clear, good people? There's been an increase in what? Taxation. Right? It's important to know that because an increase or an additional amount of tax, we have to add it to the other expenditure, which is current tax, to get the total tax expenditure. If you had come to this calculation, you had found that it's actually reversed. The deferred tax liability has reduced in value. What reduces a liability? It is income. If that is the case, you were going to reduce your expenses here. Because where current tax gives you an expense, deferred tax would have given you income. So you would have had to deduct that. It is not always that we add deferred tax. Sometimes we subtract it. If the theory is difficult, you just claim that if it is a negative amount here, then when you transport it this side, it is a positive amount and the opposite is true. You won't be understanding, but you still get the marks. Right, are we clear? Right, good people, are we there?
We here.
Right, so now this movement that we have has ignored the change in rate. Right, if you go to this calculation here, right, remember this is the temporary difference in the prior year. This is the temporary difference in the current year. So therefore, we have taken the current year's temporary difference minus the prior year, then we multiplied that by 28. We have completely ignored what? 29%. So therefore, we are saying based on current operations alone, we had an additional expenditure of what? 66,920. Right. However, we are saying what is the impact of the movement in the rate? What is the impact of the movement in the rate? Right. You had a deferred tax liability. Anything that increases a liability increases expenditure. Anything that reduces a liability reduces expenditure or represents income. So if this figure, this is the only figure that was affected by 29. This figure, you've got to remeasure it down to 28%. There is a decrease of 1% in terms of rate. So that decrease is a reduction in terms of that amount. We need to account for that. However, to account for that is very easy. You take the deferred tax amount for the current year, which is the 315,840. Right, then you subtract the previous year's figure. They are all liabilities, which is 257,810. Right, so 315,840 minus 257,810. Right, then we get an amount of 58,030. So 315,840 minus 257,810. So we are saying that the movement overall in deferred tax, taking into account current operations for the year and the change in rate, gives you that amount. Then what is the change in rate? The change in rate is 257,810 divided by 29. Right, however, what you can do, this figure can just be a balancing figure here. So you say 66,920 minus 58,030, then you get a figure 8890. This is simple to say the deferred tax balance from the previous year fell by 1%. So 257,810 divided by 29, it will give you that amount. A reduction in deferred tax is income. That is why we are deducting it from that figure to get that amount. Any questions, good people? Right, are we following?
Yes, we are.
Right, wonderful. So that is how you calculate what is called the SA normal tax. Right, so we are saying from South African sources, this is our tax expenditure. So 40,108 plus 58,030, that gives us an amount of 98,138. Right, however, we were also charged foreign tax. So that adds to our expenditure. Right, the foreign tax, 132 is the foreign income but tax in the foreign country is at 35. So therefore, we are saying 98, 132,000 multiplied by 35. So 132,000 times 0.35, right? We are supposed to pay this tax. Now the question is, have we paid it or not? Right, but to get the total expense, we say that plus 98, 138. So our income tax expense is 144,338. So this is the figure that you represent here. That's our income tax expense for the year. Right, so we get 590, 662. This was not there. We don't have other comprehensive income. Right, so we'll be done with our presentation, but I may need to revisit one calculation here. Have we paid the foreign tax? The current tax, we haven't paid it. Right, let's go to the foreign tax they're explaining here. Right, no foreign tax was paid over during the year. So therefore, what it means, we also owe the foreign tax amount. We haven't paid it. So therefore here, we should take this amount, 3608 plus 46,200. Right, if they had said the company has already paid foreign tax, we would not have included here, we will not be owing anyone. But we are owing for foreign tax plus current tax 3608. So overall, we are owing 49 here. Right, I put the 36 before checking whether we paid this amount or not. Right, any questions, good people, on what we have on the board? Right, if we are following, the last thing that you are going to do is what is called a tax rate reconciliation. With a tax rate reconciliation, we are going to calculate what is called the standard tax. The standard tax will take the 735, which is the profit before tax, and we multiply by the current tax rate of 28%. Right, then we are going to get a value of 205,800. So we want to reconcile this amount and that amount. So we just want to check ourselves and say, can we see where the differences came from? That's what we want to do. Right, to say if we take our profit before tax, which is that value, and multiply it by the current ruling tax rate, does it give us this amount? If it doesn't give us this amount, what are the reconciling items? Then we say, when calculating this, we included also the exempt differences in calculating this. But in calculating this, we did not include exempt differences because in calculating the current tax, we eliminated the exempt differences. So part of the reconciling items is the foreign income. It is the dividend tax or dividend income. It is capital gain. It is fines and donations. Right, it was also legal fees. This one I remember, 700. This one I remember, 900. This one I remember, 132,000. This one I no longer remember. I go and check here in my calculation. All right, so dividend 175, capital gain 42,000. So 175,000 here, and then 42,000 there. Right. These are the original figures before any tax impact. Right. But since I have already extrapolated their impact in terms of taxation here, if I'm going to now reverse these, I now have to reverse them after 28%. So multiplied by 28%. Right. Are we following, good people? So now I'm saying in this calculation that we have here, I had not removed exempt differences. So if I'm going to get that figure, I must now remove exempt differences. That's what we are saying. 900 by 0.28, that gives you 252. And remember, this was an expense at back. At 700 times 0.28, 196 here. Right, 42,000 by 0.28, right, 11,760 income deduct. 175 times 0.28, income deduct 49,000. Right, but on the foreign income, we have got to be careful. This is because in here, I've included 28% of 132. However, in here, in this calculation, on foreign income, I had included 46,000. So therefore, the difference is not the full amount, but whatever we get there minus what? 46,200. So 132,000 times 0.28 minus 46,200, right? It will give me a deduction of 9240. Right. Any questions on that, good people? Right. Are we on the same page?
Yes.
All right. Right. Now that we have eliminated the impact or the differences in terms of how we treated the exempt differences, we then say, in this calculation here, we had not included these two amounts, the over provision, right, and the change in rate. So we bring down the over provision, right, which was 1.5. In calculating this amount, it was deducted from the current tax. In calculating the impact of deduct tax, we had also deducted 8890, which is change in rate. Right, then you add everything. 205,800 minus 9240. Again, this one we are adding. This one we should be adding. I get to 132,000 times 0.28. It gives me 36,000. But we are saying that at the top here, we would have deducted what? 46. So therefore, if we now reverse that, we will be less by 9,240 from what these guys actually included in their calculation. They included 46, but when you calculate this here, you get 36,900. So we have to also add the difference between the two. Right, when everything has been calculated correctly, these two figures must balance. Right, so you know that everything is good with your calculations and you probably get 100% of that question. So this is what we were expected to do on this one. Any questions, good people?
Is I trying to find out for on the dividend income, that 20% portion is not applicable when you do the tax rate reconciliation. Capital gain, sorry.
On the capital gain.
Yes.
It doesn't. Remember now what we have done here. We removed this amount from profit before tax. So this amount that we are dealing with already taken into account the 20%. So Tina, we are saying this amount is what was deducted from 735,000 a year. See, right, after taking into account the 20%. So when I'm here now, I'm saying I have included on that 735 this amount. So now to align with this figure, I have to remove it. That's why I am deducting it. So this I multiplied by 28, this I multiplied by 28, so I've reversed appropriately there. It won't affect you when you come here on this one.
Okay.
Yes. Right. Any other questions, good people? Right. If there are no questions, then let's hold it right here. What I normally do is in the next session, I'll bring a similar question. Maybe I may add one new thing on top of this one, right? So that we practice effectively what we have covered, because this is a lot. You need to have another question, which does not confuse you too much. And then after that, we add something. So I may bring a similar question, but maybe on that very similar question, I'll just throw a little bit something, maybe a deferred tax on other comprehensive income, right? And then we cover that. So it will be just one more thing that I'm bringing on, but covering everything. So that's what we'll do next week. I'll bring a similar question with just one more additional item. Then we practice. So what you do as a student, don't sit on the work. Go through the work again on your own. So that next year, as we move a little bit with the syllabus, right, the stuff from behind, you are well away, because there will be continuity in the classes there. So if you miss it here when we come back next week, and we are now introducing something new, then you will have a hard time following. Right, at this level, I told you, Ziabu. So you need to work very, very hard also on your side. You can't wait for the lesson next week. Do something on your own. You can even go to your question bank, look for a different question similar to this one, attempt it so that you can gauge how far you are going. You'll also be able to pick out areas that maybe you need clarity on. Those are the ones next time when you do a question, you concentrate on, and you'll be able to ask the relevant questions. So 1 hour, 30 minutes before you sleep, or 1 hour, 30 minutes in the morning every day. Try and condition like that, Monday to Friday. Weekend, you have time. If you can do that, then you will struggle less with CTA. Usually the struggle here is not about understanding. Everyone who is here, obviously you have the intelligence to be here. But the challenge is, can you manage your time and your study program efficiently? 1 hour, 30 minutes before you sleep, or 1 hour, 30 minutes in the morning. Have that habit every day. Study one module per day. And then weekend, now you have more time to then see which areas you are struggling with. You concentrate on those. If you do that, you'll be good. Right, that's my advice. Thank you very much. As usual, I will share later in the evening tonight. Thank you. Sharp, sharp.
Thank you, David.
Sharp, good people.